Trailing stops in trading. Different types every trader should know. In trading, protecting profits is just as important as finding profitable opportunities. Many traders spend hours learning how to enter the market at the perfect time, but often overlook one of the most critical parts of trading success: knowing when to exit. This is where trailing stops become an incredibly valuable tool. Whether you are trading stocks, forex, cryptocurrencies, or options, trailing stops help traders manage risk while allowing profitable trades to continue running as long as momentum remains strong. A trailing stop is a dynamic stop-loss order that automatically adjusts as the price of an asset moves in a favorable direction. Unlike a traditional stop-loss order that remains fixed at one specific price level, a trailing stop moves along with the market price. The main purpose is simple: protect gains while giving the trade room to grow. They remove emotional decision-making by automating the exit strategy. Instead of guessing when to close a trade, traders let the market determine the exit point. This creates discipline and consistency, two qualities that separate successful traders from inconsistent traders. A properly placed trailing stop allows traders to maximize gains while maintaining a predefined level of risk management. At its core, a trailing stop is a tool designed to follow the price movement of a security once the trade starts moving in your favor. Imagine buying a stock at $100. You decide to set a trailing stop of $5. If the stock rises to $110, your stop automatically moves from $95 to $105. If the stock rises further to $120, the stop moves to $115. However, if the stock suddenly drops, the trailing stop remains fixed at the highest adjusted level. So if the stock reaches $120 and then falls back to $115, the stop triggers and automatically exits the trade. The biggest advantage here is that the stop trails behind price movement rather than staying fixed. This allows traders to stay in winning trades longer while protecting profits from sudden reversals. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 20% off your next purchase. The concept behind trailing stops is straightforward. Once a trader enters a position, they decide how far behind the current price the stop should follow. This distance can be measured in several ways. Some traders use a fixed dollar amount, while others use percentages, technical indicators, volatility measurements, or chart structures. If the market continues moving favorably, the stop moves along with the price. If the market reverses by the predetermined amount, the trade automatically closes. Importantly, the stop only moves in one direction. It never moves backward. For long trades, the stop moves upward as price rises. For short trades, the stop moves downward as price falls. This simple mechanism helps traders protect profits without manually adjusting stop-loss levels throughout the trade. There are several different types of trailing stops traders can use depending on their strategy, market conditions, and trading style. Understanding these variations allows traders to choose the most effective method for their specific goals. Fixed dollar trailing stop. A fixed dollar trailing stop is one of the simplest forms of trailing stops. The trader chooses a specific dollar amount that the stop follows behind the price. For example, suppose a trader buys a stock at $50 and sets a trailing stop of $3. If the stock rises to $60, the stop automatically moves to $57. If the stock rises to $65, the stop moves to $62. If the stock then falls to $62, the trade exits automatically. This approach is easy to understand and works well for beginners. However, the weakness is that market volatility varies. A fixed dollar amount may be too small during volatile periods or too large during calm market conditions. Percentage-based trailing stop. A percentage trailing stop uses a percentage instead of a fixed dollar amount. This approach automatically scales based on the price of the asset. For example, a trader buys a stock at $100 and chooses a 5% trailing stop. If the stock rises to $120, the stop moves to $114. If the stock rises to $140, the stop moves to $133. If price falls 5% from the highest point, the trade exits. This method is popular because it adapts better to different stock prices. Whether trading a $20 stock or a $500 stock, the percentage remains proportional. It offers flexibility while maintaining consistent risk management across multiple trades. Moving average trailing stop. Some traders prefer using moving averages as dynamic trailing stops. A moving average tracks the average price over a set period and moves as price changes. A trader may decide to remain in a trade as long as price stays above the 20-day moving average. For example, if a stock rises steadily while staying above its moving average, the trader remains in the position. Once price closes below the moving average, the trader exits. This strategy works especially well in trending markets. It allows traders to ride trends for longer periods while using technical analysis as a natural exit point. The downside is that moving averages can lag behind price action. Sometimes profits shrink significantly before the exit signal appears. An average true range-based trailing stop. An average true range trailing stop adjusts based on market volatility. An average true range measures how much an asset typically moves over a certain period. Higher and average true range values indicate more volatility. Lower and average true range values indicate calmer markets. A trader may decide to place the stop to an average true range values below the highest price reached. For example, if a stock trades at $100 and an average true range is $2, a trader using a 2 times an average true range stop would place the stop $4 below price. If volatility increases, the stop naturally widens. If volatility decreases, the stop tightens. This method is extremely popular among professional traders because it adapts to changing market conditions automatically. Chart structure trailing stop. A chart structure trailing stop uses price action and technical analysis instead of fixed mathematical calculations. Traders move their stop below important support levels, swing lows, trend lines, or recent market structures. Suppose a trader buys a stock during an uptrend. As the stock forms higher lows, the trader gradually moves the stop below each new swing low. As long as price continues respecting those support areas, the trade remains active. If price breaks below support, the trade exits. This method works well for traders who understand technical analysis and market structure. It often provides better flexibility than fixed stop systems. Time-based trailing stop. Some traders use time-based trailing stops, especially day traders. Instead of focusing entirely on price movement, the trader exits after a certain amount of time if momentum slows. For example, a day trader may decide to close any position after 2 hours unless price continues making new highs. This approach prevents holding stagnant trades unnecessarily. It is often used in combination with other stop-loss strategies rather than as a standalone system. The biggest advantage of trailing stops is profit protection. Once a trade moves into profit, trailing stops lock in gains while allowing the trade to continue growing. Another major benefit is emotional discipline. Many traders struggle with fear and greed. Automated trailing stops remove subjective decision-making. They also reduce the need to monitor trades constantly. Instead of manually adjusting stop levels, traders allow automation to manage exits. Trailing stops also improve consistency by forcing traders to follow predefined risk management rules. Over time, consistency often leads to better long-term performance. Although trailing stops are powerful tools, they are not perfect. If placed too tightly, normal market fluctuations can trigger early exits. This causes traders to leave winning trades before the trend fully develops. Markets frequently experience temporary pullbacks before continuing upward. Tight stops may mistake these pullbacks for trend reversals. Another challenge is volatility. Highly volatile assets like cryptocurrencies can move dramatically in short periods. Poorly positioned trailing stops can trigger unnecessarily. There is also the risk of price gaps. If a stock gaps down sharply overnight, the execution price may be worse than the stop level. Understanding these risks helps traders place trailing stops more effectively. The key to successful trailing stop usage is matching the stop method to the trading strategy. Short-term traders often prefer tighter stops because they focus on quick moves. Swing traders usually allow wider stops to account for daily price fluctuations. Long-term investors often use moving average or percentage-based trailing stops. Volatility should always be considered. Markets with large price swings require wider trailing stops. Calmer markets allow tighter stops. Backtesting is extremely important. Traders should test trailing stop strategies using historical price data before risking real capital. Combining trailing stops with technical analysis often produces better results than relying on trailing stops alone. Support and resistance levels, trend lines, and volatility indicators help determine better stop placement. Trailing stop example. Imagine you buy shares of a company at $100. You decide to use a 10% trailing stop. Initially, your stop sits at $90. The stock begins rising. It climbs to $120. Your stop automatically moves to $108, which is 10% below the new high. The stock keeps rising and reaches $150. Your stop moves again, now sitting at $135. Suddenly the market weakens. The stock falls from $150 to $135. The trailing stop triggers automatically. Your trade closes at approximately $135. Although the stock moved against you, you still captured a $35 profit per share. Without the trailing stop, you might have hesitated and watched profits disappear. Conclusion. Trailing stops are one of the most powerful risk management tools available to traders. They help protect profits, reduce emotional decision-making, and allow traders to stay in winning trades longer. Whether using fixed dollar stops, percentage-based stops, moving averages, average true range-based methods, or chart structure analysis, trailing stops provide a disciplined framework for exiting trades intelligently. The key is understanding that no single trailing stop works perfectly in every market condition. Traders must adapt their stop strategy to volatility, time horizon, and overall trading style. When used correctly, trailing stops can dramatically improve trading consistency and help traders maximize gains while minimizing unnecessary losses. Mastering trailing stops is not simply about protecting profits, it is about becoming a smarter, more disciplined trader capable of letting winning trades run while controlling risk at every stage of the market journey. Thank you for watching.